Welcome to the Magnify Wealth Podcast with Scott Gannon, where we explore the power of the infinite banking concept, combined with the value of cash-flowing investments for business owners and real estate investors. Join the team as we dive into case studies, interviews, and strategies to help you grow and protect your wealth. Gain valuable insights and actionable advice to magnify your wealth today.
Welcome, everybody, to another episode of the Magnify Wealth Podcast. I'm here with our host, Scott Gannon. So today, Scott, what we're going to be talking about is 6 different reasons that business owners should be looking to incorporate before they're even ready to. But that makes sense, to incorporate before your accountant even tells you to?
That's kind of where this subject came up when I kind of developed the tips. Was times when people talk to their accountants, there's like a line in the sand on an income when it makes sense and whether they're spending all their money or not. And yeah, so I kind of came up with kind of good reasons. And this kind of goes back to even myself. Once I was allowed to incorporate under my licensing, which was back in 2002, I incorporated right away. And this was actually advice of a chartered accountant that happened to be an advisor as well. He said, Scott, you need to incorporate now. Don't wait.
So I think the first thing we should probably do is say, we are not tax accountants. We should have this conversation with a tax accountant before doing anything. However, what we're going to do is put 6 tips in your head that you might want to bring to the discussion.
Bring to your account. Yeah. So like anything, we're definitely not in the tax advice business. So we're just sharing information. We're not actually giving tax advice.
So why don't you start us off with our first one?
Well, the first one is controlling of your income. And what that means is because you have your revenue go into your corporation, actually taking it out personally is kind of your choice. Now, obviously, you have bills to pay. You have personal expenses that are obviously going to happen and you're going to need the money for. But that doesn't mean that there aren't other ways to control that income and plan it appropriately. And even in times of, and although I usually don't recommend this for people, but I've had people come to me and say, I need to get my income up so that I can finance a house or whatever for mortgage reasons. And to some degree, if you're operating with money in your business, you can certainly declare higher incomes. Than you normally would have, just to get that income up. But the bigger thing for me is being able to control using what's called shareholder loans. That's kind of into and out of the corp, as well as timing of when you pay yourself. You can always defer to, say, January if your year end was end of December, to taking more money out of your corporation, so you actually don't have to pay the tax on that money for, say, 14, 15 months or whatever it is.
So that being something I know you use a lot, why don't you just give, a personal example of like how do you take your income?
So I do 100% dividends, and that kind of feeds into our next tip there, and I'll get into in a minute. But all my income is dividends, and we basically stopped taking dividends. I take a dividend every month, except for I usually cut it about in half in November, and then don't have any in December, and then I just declare a larger one in January. Okay. So yes, we do have cash available personally that we can carry us through there, but don't ever forget that paying 30 or 40 days of interest on a line of credit personally might be helpful to deferring a tax bill for, like I say, could be 15, could be even 16 or 17 months, depending on when you file.
And a lot of times what you do, though, is, you're taking shareholder loans throughout the year and figuring out what that number that you're going to declare at the end of December is.
Well, yeah, I mean, you can do that. It's probably better to know that you have a consistent payment of a dividend, but you certainly can accumulate them as shareholder loans during the year and
a portion of them if you're
exactly.
Give yourself some leeway at that.
Well, yeah. So, and that's usually what I do. I usually have a portion of our revenue is shareholder loan during the year, And if we have the extra money, like let's just say we have an extra 10 or 12 or $15,000 in the bank account, then I'll pay that back in that current year so that it doesn't, then I don't have to declare it.
Makes sense. That makes sense. Number two.
So number two is choosing whether to participate in CPP. And there's something that if you're not aware, when I say I take 100% dividends, I chose back in 2002 to not participate in CPP. When you're self-employed, you pay both the employer-employee portion. So it's a big number that you're just taking out of your own control and giving it to the government to control. Now, the projection is it'll be there, and I'm not saying it's not going to be, but it's contributing to a pension, which you're relinquishing control and access to that cash. And that to me is that's a flat out, that's a hard no for me. I want control of my money all the time. And if I don't have to contribute to that, then I will. I'm not saying that I don't save the money. Obviously I do. I save a lot of money, but I certainly don't save it in the CPP or government coffers. I just don't see the value. CPP, if you really understand too, the way the income works is if you have a 2-income household, it's not designed for that. It's designed for the single family house. Whereas there would be a survivor's pension or a widow's pension when one spouse passes away, but both spouses are maxing out into retirement, then that's the maximum you'll get. So if one of you passes away the day after you start spending it, the surviving spouse gets $2,500, and that's taxable. It's $2,500, so you could put whatever $200,000, $300,000, $500,000 into this thing over your lifetime, and the growth on it be worth way more than that, and get $2,500. That's a hard no from me.
Well, let's move on to number three, because I think we know how you feel about number two.
For sure. So build credit and credibility as a business. So this is something a little more intangible, but when you start a business, everything comes with, when it comes to you dealing with banks, you have to personally guarantee everything. They won't give you you don't get handed the stability of a business by a bank. And when you incorporate and you start doing things in your corporate name, then you start to build that credibility. Understand that being a sole proprietor or even a partnership, you're always looked at personally when a bank talks to you, because your business and yourself are one and the same. That's the unfortunate part of being as a sole proprietor, it's like say, or partnership, whatever, just something that's not incorporated business. You and your business are the same.
Yeah,
that's it.
Creating the other entity allows that entity to start building
its own identity. Right.
Exactly.
But I'll leave that there. It's more of an intangible.
Yeah. Well, we'll move on to the fourth one then,
which is again another. This is that's not really intangible, but it certainly can be, and that's potentially control your liability. As soon as you start separating yourself from your business, and you're able to build that credibility, then now you can take yourself away from the liabilities of the business, whether that be from being sued by somebody slipping and falling on your property, or just a pandemic happening and you're go out of business, right? Like these things happen. Obviously, we're well aware of what happened over the last 4 or 5 years, or 3 or 4 years, I should say. And so that's another reason to again incorporate early before you think you're ready.
Yeah, because in that case, your business might take the hit, but personally, you're not destroying your own assets.
Yeah, exactly. Yeah, everything's in play if you're personally connected.
Number 5, I'm a big fan of. Why don't you introduce
So 5 and 6 are big ones for us for sure. So number 5 is HSAs, or what's called health spending accounts, or we call them HSAs. And what a health spending account is the ability to set up, and there's obviously there are some qualifications on this. If you have employees, they have to have some access as well, but you can create like different, what's the word I'm looking for, different employee status, whether it be owner, manager, or executive versus employees.
If employees are doing the same thing, they need to be on the same status, basically.
But they see, and that's a great thing too with employees, because it's another benefit that generally they love. because it's tax free. And that's really what it is. And so it's health, dental, prescriptions. All these things are what we call tax-free insurance benefits. They are tax-free benefits. And what that means is your company can pay those expenses and your employee or yourself does not pay tax. It's not a taxable benefit. Like if you get if you're an owner and you pay for life insurance for your company, that's a taxable benefit. Why? Because the death benefit is tax-free, so it's set up differently. But with health spending accounts or with health, group health plans, these are tax-free benefits inside. You can have your life insurance inside. That's a taxable benefit to your employee, and then the health and dental disabilities is a whole other conversation. But I'll leave that one for now. But the health and dental, which everybody's focused on, everybody wants help with that, and it is truly a tax-free benefit. And what does that mean? That means that you can have an expense like massage therapy, and you use it personally or you do it personally, you pay it, and generally speaking, if you make enough money, it's not even going to give you even a tiny bit of tax benefit. When you do it through your company, you're using company dollars and you get to use the benefit tax free. Now, if you're in a 50% tax bracket, if you got a $1,000 bill, it's actually costing the company, it's costing you only $500 through your company to do it.
So from an overarching standpoint, it's the company paying the bill, and the company gets to write that off as a tax expense.
It is a tax expense.
And it's not a shareholder benefit for the shareholder. As long as they're working in the business to make this work, they have to be working in the business. And what we do is we look at what would you pay an employee to do that, and somewhere in the 10 to 20% range of that income level is what we're able to
go up to. It's obviously not required, but
over the course of a year.
Yeah, exactly. So the great thing is, like I said, I use the $1,000 as what we see a lot from business owners is when the kids need braces. Like they might have a health plan, and that health plan covers a maximum of $3,000 or something, but it's like $9,000 for the braces. They take the other $6,000, company pays it, deductible to the company, tax free to the owner or the employee.
Gotta love double tax breaks.
Yes, it's a win-win, and it's only available to incorporated businesses. You can't be a sole proprietor and have a whole health spending account.
And the best part for setting it up too is there's no cost to set it up. It's just it's available for you. There's a fee to making these transactions, these claims through it, but it's a lot less than the tax, and there's no cost to set it up, so you can have it available for if and when you want to use it.
Yeah, exactly. So meaning what Cameron's saying there when he says no cost is it's like you don't even have to fund an account or anywhere. It just comes from your operating account. It's when the expense comes, if it comes, you pay it, and actually the employee or yourself pays it, and then the company reimburses you. That's how it works. And it's all done very efficiently through an app on your phone. It's a great little tool for sure.
All right, I think we've pounded this one to the ground. So why don't we move on to the real juiciest one, number 6?
Well, we call it the juiciest one, but it really is. I mean, it's something that a lot of people don't think about for the simple reason that they may be using other methods of saving than just directly saving their money versus like an RSP or something like that. Like I see this all the time. I'll come in and sit across from a business owner, and I say, "Well, how are you saving your money?" Well, my accountant tells me to bonus out the RSP, the maximum RSP, and I put that into an RSP. Well, what you've done is you've taken corporate dollars, paid them to yourself, and added that to your income, and then deducted it. So you're in a tax neutral position. Now you've created a fully taxable asset, or call it an asset, a fully taxable investment or savings account just by moving the money out of the company.
In other words, what you did is you created a tax liability, push it to the future, hoping and praying that the tax isn't what it is today in the future.
So it's somewhat less. So the logic behind RSPs, I mean, I can go on and on about all day with that, but I'll just touch on that a little bit. Is that goes on the assumption that you're hoping to be poor when you retire, and I don't know. Most of the people I deal with, they don't want to be poor. And frankly, that's, my goal with people is to make you as poor as possible in your tax return. That's it.
Okay.
As rich as possible in your
Well,
bank account. But
so if this is the case, what's the alternative to saving?
Well,
if we don't want to pay the tax today,
again,
personally.
there's several ways you can do this, but generally speaking, is leave the savings in the account. Whether you're an investor, you want to reinvest in your own business, reinvest in yourself, or what we do infinite banking, and infinite banking is a great strategy inside of a corporation. You're using corporate dollars to save, and that's really where it boils down to is the numbers. If you're in a small business tax bracket, which is $500,000 or less in profit, you're paying no more than 12 cents, depending on where you're listening to this at in Canada. Is Nova Scotia, it's 11.5 cents percent. Most provinces are around 12.2 or whatever, but right in that range of about 88 cents on the dollar you get to save after you profit. Whereas if you pay it out, you could be paying up to 52.7% tax, so you're looking at 47.3 cents being saved. And again, I'm ignoring that RSP conversation because to me it doesn't make any sense anyway. All you're doing is neutralizing,
creating a tax liability.
Yeah, you're creating a tax liability in a tax neutral position, which makes no sense in my mind. But that's a whole other story. But really, the end of the bottom line here is you're building your savings within the corporation, and if you set it up properly, you can still have a very tax efficient estate plan as well. And guess what? We can help you with that.
So if I'm going to save inside a corporation for my retirement, now what? Am I going to be able to use that money in retirement personally?
Well, ideally,
maybe I'm in a business that I want to sell someday. Is that gonna work?
Well, it will. It's just a matter of how you set it up. A lot of what we're talking about here is setting up however you're going to save it. Yeah, yes, we have a very efficient way to do it, but that doesn't mean you have to do it that way. As long as you're investing inside your corporation, whether you're saving, investing, it's like I said, you can invest yourself, expand your business. These are all things that are going to give you capital when you retire. And how you do that, obviously we can help you and guide you on that. What Cameron was getting at with respect to inside the operating company is you don't want to have all this money tied up in an operating company. If you want to keep it, whatever you're setting up, whether that be a life insurance policy or an investment account, or separate real estate investments, or whatever, is you want to eventually set up a trust and holding companies for that. Not only for the ability to keep it once you sell your operating company as a going concern, but also just to separate liability. Like if you're going to leave money inside your company, you're not going to want to keep it there available. Like it goes right back to number 3 about number 4, the liability is, do you really want that money exposed to the corporate liability? Well, we can move it. Like there are ways to do that. So, but this is I think is getting outside the scope.
We're a little in the weeds.
The scope here is the 6 tips as to why you might want to incorporate before you're ready, or before you think you're ready.
And that's to start saving now in that efficient manner.
Exactly.
Awesome. Do you have any lasting wisdom before we say bye to the folks till next week?
Well, all of these things are something to look at. You can look at them as a group, you can look at them separately, but to me, they just line up as control. And that's the first thing. When I always said, like, number 1 was control your income. Well, that's, everything is about control. If you're putting it into CBP, you're taking it away from your control. Are you controlling your income? Well, if you have to declare it, if you're self-employed, or sole proprietor or partnership, whatever, not incorporated.
Are you controlling your liability? Are you
So this is
controlling your savings. It all does come back to that single word.
So we want to start by controlling your capital, and then of course, as our name says about magnifying your wealth, we want to magnify it. That's it.
Awesome. Well, All right, folks. We'll see you guys next week on the Magnify Wealth podcast. Have a good one.
See you later.
Thanks for tuning in to the Magnify Wealth podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.